Getting Back to Even by Jim Cramer. The day is October 8th, 1998. Jim Cramer just lost $91 million and was worried about his reputation and his job and needed to recover his money fast. Over the next 3 months, he ended up making $110 million, averaging $1.4 million a day. So if there's anyone that knows how to get back to even in a short amount of time, it's Jim Cramer. He goes on to explain that buying and hold is dead. It is a tactic that no one should really use anymore. And that instead, people should buy and homework, meaning you should buy your stocks in at least 1 hour every single week. Make sure that you still want to own this stock. Here is 5 rules. Stocks are not a substitute for a savings account, meaning that if you're going to need any sort of money within the next 4 to 5 years, do not put it in stocks. Any money outside of 4 to 5 years, your excess funds, you can put into stocks and have it invest for you. Rule number 2, never ever be afraid to sell when things look like they're headed down the tubes, but never sell everything just in case you miss a rebound. Because more often than not, if you do sell everything, you will miss that rebound. Yes, you did already lose a ton of money in a crisis, but there's no point in selling everything. Rule number 3, skip the 4 stages of portfolio grief: denial, anger, bargaining, and depression. It doesn't work anyways. Being that with the first stage is denial, you stop working, you stop doing your homework, you start checking the news, you stop checking their portfolio, you start checking everything on the stock, and you stop being up to date, which already again puts you at an even bigger disadvantage. The second one being anger, you start to blame everybody for your losses. You blame the media. This doesn't do anything but expend more energy that is even needed. Next is bargaining. There is no point in trying to bargain with the market and saying, oh, I'll just wait for a rebound just in case it happens. If it's a bad stock, it's a bad stock. And 75% of the time, they never do come back. And finally, the last stage being depression. There's no point in being sad. Self-pity is a waste of time and should be avoided at all costs. Rule number 4 is to stop the bleeding and shun the stocks that are supposedly cheap. No stock is cheap if it keeps getting lower. He shows you one way you can tell if a stock is cheap or not, having P divided by E equals M, with P being price, E equals earnings per share, and M being the multitude. Then taking this equation, having PEG, with the multitude being divided by G. And if their growth, which is for G, if their growth rate is between 1 and 2, it's a normal stock, it's normally priced. If it's under 1, it's a cheap stock. And if it's greater than 2, it's an expensive stock. And rule number 5 is look at the balance sheet. If the debt is coming up or is too much, be aware that stock that has to pay that back, and it could affect it. And a bonus tip number 6, investing is all about augmenting your paycheck. You still need a job in these hard times. It's not supposed to be a substitute for your paycheck. You do need a steady source of income no matter what. Next, he talks about how you need a diversified portfolio, about 20% in every sector, and at least between 5 to 10 stocks. Gold is a perfect insurance for your portfolio. What typically will send stocks down, usually will send gold up, making gold a great way to hedge your account. Do not try to predict the market. You are not an oracle. And another common misconception that stocks fundamentals are everything, when in fact they aren't everything. So if fundamentals don't move stocks, then what do move stocks? And these are hedge funds, mutual funds. News will move stocks. Once you know how the hedge funds and mutual funds work, you can beat them in their cycle investing. Jim's favorite attribute about stocks is dividends. He talks about how yes, it is a boring, mundane way to invest, but in fact that's actually not true at all. And he goes to explain how dividend investing is one of the best ways to invest. He explains the must-own date. And this is 1 day before the X date. And the must-own date is the day you can own a stock and still get paid a dividend for owning it. And the best stocks to own are accidental high yielders. And since they become accidental high yielders, there's usually a yield support on them. Meaning when a stock's dividend yield gets too high, people generally start to put a lot of buying pressure on it, sending the stock higher. He then gives the example that if a stock doesn't move for 10 years but has a 5% yield and you reinvest your dividends, over the next 10 years you will still get a 64% gain on that stock no matter what. And the way to tell if it's a high dividend yield or not is to check when they last paid out that dividend percentage and what was going on in that time and how it can be reflected to now. However, be aware that extremely high yields are a red flag because they don't have to pay out their dividend at that price. So you need to check if they're able to pay it at that price. And the way you do that is by checking their cash flow and their balance sheet. They need to be able to pay 2 times out over its earnings. And even greater news, short sellers typically don't like to buy these type of stocks because short sellers have to pay out that dividend from their own bank account since they're shorting that stock, which gives you even more buyer's protection. He then explains that preferred stocks have a fixed dividend. He then goes over how cyclical stocks when the economy starts to recover, like bank stocks, are the best among a financial crisis. And the fastest way to get back to even is actually through options. Talks about how stocks are too slow and gives the example of Google and how if you have 10 shares of Google at $400 and it moves up $50, you only make $500. But Google, being as volatile as it was back then, if it were to drop $100, you would lose $1,000, making your risk reward not too great, let alone the capital to have to build up just to make that profit. He explains in the money calls, out of the money calls, and at the money calls, and how in the money calls, while costing more and had more downside, was the best way to gain appreciation. And even more so, the best way to get the best risk reward is with deep in the money options. The next chapter he goes over talks about taking options to the next level. In order to keep this book summary at least a little bit shorter, since this is an extremely complicated concept, I'm going to leave it out of this video for now. Leave a comment below if you want me to go over this super secret, super extremely complicated, but super lucrative concept with you. I can make another video in a short time. But moving on, here are his 25 rules for a post-apocalyptic investing. Rule number 1 is be careful of upside surprises. And what he means by this is be aware of fake news. The way you want your stock to move up is if it's real organic news, not something forced into the market. Rule number 2 is the indicators that matter can change in a heartbeat. Never stop trying to find out which ones matter most. And it gives the example of the Baltic dry freight. And this is a freight that goes from China. And it explains how this is a good way to tell if the market is coming back, is how active they are doing. Number 3 is know your fellow shareholder. The reason being is because you want to know if a lot of institutions own it or if a lot of retail traders own it. There's a huge difference in how that stock is going to trade. Rule number 4 is it pays to follow dumb money, mutual fund money. Look at their portfolio. Now what he's talking about here is when a time of crisis, a lot of people decide to put their money into mutual funds. When this happens, the mutual funds have a lot of excess money. And instead of trying to find new stocks, what they decide to do is they'll invest into stocks they already own. So look at these mutual funds. They'll tell you what stocks they already are currently trading in. And what you could do is you could put your money into the exact stocks that they own. And whenever they get a surplus of money, they're going to pour their money into the stocks they already do. Mutual funds and hedge funds managers are just as predictable as people. They're lazy and they want to invest the stocks that they're already invested in because they like them for a reason. Rule number 5, a bear market rally is still a rally. A lot of people will poop on a rally in a bear market saying it's a false rally, but it's still a rally. You might as well capitalize on those gains. Yes, you might be swing trading those stocks, but it's still a great way to make money. Rule number 6, don't assume commentators who dislike the market are honest. Same thing goes with the commentators that do like the market. Everybody has an agenda. You could still learn from them, but you do need to do your own research and make your own collective opinion about the market as a whole. Rule number 7, don't look at the averages. Breadth is just as important. And basically, breadth is a measure of the number of stocks that are going up versus down. You want to have good breadth. The more stocks going up with the market as a whole, the better for the market. Rule number 8, don't trust buybacks. A lot of companies will do a huge buyback because it's ingrained into our mind that buybacks are great for the investor. It's a way to give back to them, making less shares available, making their shares more available. But on the contrary, sometimes a lot of companies will do buybacks to make their stock seem more appealing than it actually is. And instead, the managers at that company will be dumping off their shares until the new wave of retail investors excited to buy the stock that's having a huge buyback. And to be even more aware of a dinky dividend in a big buyback should ring a lot of alarm bells. Rule number 9, Technicals matter. Try to look for the day to see if there's a huge buying going on in the market or a huge selling going on. Rule number 10, don't dig your heels when you're wrong. When you're wrong about a stock, you need to still do your homework. And when the facts change, you need to change your mind. Rule number 11, don't take your cue from the albus of an inferior company. Just because one company is doing wrong doesn't mean another company is doing bad as well. It could be just them saying that the market is bad. Might not be true. Look at companies in the same sector to see how they're doing as well. Rule number 12, inventory matters, especially when credit is tight. Look for the companies that are moving a lot of product. Companies that have a ton of inventory and aren't moving it are probably doing really, really bad, and you don't want to own those stocks. Make sure to do your homework. Rule number 13, be aware of stocks that shouldn't be stocks. These are stocks that are going out of business. He gives the example of Fannie Mae and Freddie Mac and how they should not be traded on the New York Stock Exchange. It's ridiculous. Investors don't know. A lot of people will lose their money for no reason. Rule number 14, bull market's all about leadership. You need big companies to lead these rallies. It's not going to happen from the mid-cap, low-cap stocks. Rule number 15, we are no longer the center of the universe. He explains that you need to look at China. China's a big powerhouse right now. And yes, it's weird to think that they are one of the bigger economic powers now, but they are. And we need to start paying attention to them just as well to test how good we are doing as a market. Rule number 16, for the right price, even inferior merchandise is worth buying as long as it's not deteriorating. He gives the example on how when you go shopping at a store, you might see a $10 pair of shorts and think, wow, those are pretty good shorts, but you don't buy them. You still think $10 is too much. But those same pair of shorts at $5 might be a great buy. And you'd be like, wow, they're so cheap, I might as well get them. It's exactly how stocks work too. They may not be the best company in the world, but at a certain price, you can still make a good profit on them. Rule number 17, just because someone has a PhD or even a Nobel Prize in economics does not mean they know everything about investing. And you need to be very, very wary of these people because they are very convincing in the way they talk. They have the credentials behind them, so it makes them very, very, very dangerous. Rule number 18, keep an eye on the big picture. Basically, don't let the press fool you into believing the fate of the market always hangs on whatever is planned for the next piece of data that is coming out. The market has an agenda, and the people running the news want to push theirs. Rule number 19, be aware of historical analogies. A lot of people will make analogies to the 10-year depression in Japan or to the hyperinflation in Germany. We are not Japan or Germany. Be aware that those are just ways to scare you. Rule number 20, learning the wrong lesson from the crash of 2008 can be more dangerous than learning nothing at all. Things are often worse than they seem. A lot of people might be telling you now is a bad time to invest in the market, but usually it's still a great time. Rule number 21, listen to everyone, not just the experts. He gives the example of true religion and how during an economic downturn, you would assume that buying $400 pair of jeans would be a terrible purchase, but instead True Religion actually made a profit and the stock reflected that. Rule number 22, keep it simple. If you're worried about the market, don't try to hedge using put options or exchange traded funds. Just swap out stocks into cash or gold. If you're really worried about the market, you should do that. Rule number 23, in abnormal times, don't expect technical indicators to point the right way, no matter how accurate they usually are. Technical indicators shouldn't be your only source of information on how to navigate this market. Rule number 24, the money has to come from somewhere. In order to get the market to restart up, retail investors need to start putting their money into the market. And rule number 25, become your own strongest critic and constantly challenge your ideas. In order to become a better trader, you need to challenge yourself and you need to become a better trader. Keep testing out strategies until they work. So I hope you guys liked the video. This is definitely one of my favorite books. Remember, if you want me to do an in-depth analysis on any concept from this book to dive deeper into, or the chapter where he went over the super secret, super effective options trading strategy, I can do another video on that as well. I really hope you guys liked the video. Please leave a like, comment, subscribe. It really helps us out over here. Thanks for watching. Leave a like, comment, subscribe for more future content.